Hey, BiggerPockets, it's Matt. Today we're going to talk about multifamily. So everybody wants to buy multifamily. That's like the talk of the town these days. So we're going to talk about small versus mid-sized multifamily and the evaluations of the two, pros and cons. So for those of you that are out there that are like, hey Matt, what is a small multifamily? Well, for the purpose of this conversation, small multifamily is anything up to 20 units. Mid-sized multifamily is 20 units up to 100 units. And then there's another category that's all the way over here that I'm not going to talk about today. That's called large multifamily. And again, these are my definitions. Please don't leave a comment in the comment section below like, hey Matt, I think small multifamily is up to 40 units. I understand. There's no textbook definition for what is small and mid-sized multifamily. But with the purpose of this conversation, please allow me to have these definitions, please. But then there's large over here that's above 100 units. And the reason why we're not going to talk about 100 units or more is because the competition and the average buyer changes a lot, going from 100 up to say 100, 200, 300 units, right? The buyers get way more sophisticated. It's typically companies or very seasoned individual investors, and a lot of times you run into REITs, publicly traded organizations. You run into even insurance companies, hedge funds. All those folks get involved in the space on this side of the equation, and so a lot of the rules change, which we can talk about, but not in this video. So in this video, we're going to talk about small and mid-sized multifamily and the pros and cons of both. One is not better than the other. They're different. And I think that you should, for what you guys want to do, you should evaluate the pros and cons. And if you're looking at one, consider some of these things in your evaluation. Okay? All right. Sarai? All right. Small multifamily under this. Oh, one more thing. Definitions of small. Although it's up to 20. Some people would say, hey, Matt, shouldn't a duplex, triplex, or four-family be considered small because those can be bought as a house hack? If you guys don't know what a house hack is, look that up under BiggerPockets in the forums. There's a ton of definitions and articles and all that jazz that are written about house hacks. But in general, that's where you're living in a multifamily. And a house hack really works as if you're getting FHA financing or low down money financing because it's a primary residence. So the short answer is no, that's not only small multifamily. And the main reason why I bring small multifamily up to 20 units and encompassing 2, 3, and 4 family as well is because the biggest pro of these, which is competition. And the reason that's a pro is they're not as, you think it's competitive in like the 4 or 5 unit space, try the competition over here. There's a lot more competition on this side unless you're getting an off-the-market deal or something that is, like they call it a pocket deal, meaning like something that's not marketed to everybody. So this is a very competitive space over here. This is not as competitive. And so that's why, that's a advantage I think of here, especially once you get above 2, 3, 4 units, once you get above where people can house hack on cheap money or lots of bank financing and stuff like that. When you get into spaces like a 10 unit, there's not that many people that buy 10 units because the bigger fish that are up here don't want to bother with a 10 unit. And the really small fish that are down here even, just getting started or just wanting to play around with single family homes or whatever, they don't even want to get into the space. It's too big for these guys down here and it's way too small for these guys. So that's why I like small multi, like say 10, 15 units. Those are really great buildings because there's not that many competition there's not that much competition on these types of units. Okay, so the another pro for this type of building is there is a little bit economy of scale. What do you mean by that, Matt? I'll tell you. So some economy of scale means that rent increase. Let's talk about that. I can increase my rent on a 20-unit building by $10 a month on all my units and make an extra $200 a month or $2,400 a year. No tenant will deny a $10 a month rent increase. It's very easy to scale out some changes in the building. You can make major economies of scale effects in a building like this by doing things like putting the utilities into the tenants' names or billing the tenants for some of the utilities for the building, charging them a few bucks for a contribution to water or sewer, that kind of stuff. you can put in laundry and make some of the economies of scale effects on this size building that you're not going to see on small properties, single family homes, even the smaller stuff like down there, like duplexes, triplexes, towards the lower end of the spectrum, you're not going to see as much. But when you get into 15, 20 units, you can make some effects that are felt really big over here, but you can play with some of that economy of scale by making an incremental shift per unit multiplied by the amount of units you have can make some change. Now over here, it's drastic changes, like $10 a month times 100 units, that times 12 months a year can make a major effect in your income. But here, it's reasonable, it's money, it's worth talking about. So talking about more of the pros on the mid-size stuff. This plays here, but not as much as it does over here, and that is these deals you can get more creative in the way you finance them. The financing terms I find actually get better over here. I find that banks will do somewhere between 70 to 75% loan to value on smaller stuff like this. Once you get into bigger property, you can probably negotiate an 80% loan to value. You can get something called a non-recourse loan, which you're probably not going to get down here. But a non-recourse loan is awesome. On this side, what a non-recourse loan means is that the property is the only collateral, meaning thing they can come after if the property goes south. It means you don't have to personal guarantee. That as long as you operate the property properly and you do what you're supposed to do as an operator, the most they can come and take is the building. They can't come after and take your car and your house and your other assets and the cash you have in your personal checking account and everything like that. So that's a great thing that kicks in up here. You're not going to see that down here. Okay. Again, the economy of scale, but it's on a bigger scale on this side. Again, things like raising rents, things like reduction in expenses multiplied by the amount of units that you have. It's all just bigger numbers. So you can say, if you save 5% on your expenses and your expenses are a couple $100,000, it can end up being a lot of money. So any effort, for the good or for the bad, has a larger effect. So bear that in mind. Also, it's kind of a con. I didn't write that down, but it's also a con that if your real estate taxes go up, they can go up a lot on a building like this. Whereas if your real estate taxes go up, a couple of $1,000s or even 5% or something like that on a building like this, it might not kill you. But a building like this, a 5% to 10% real estate tax increase could really cause a major problem with the building. So again, that could be a con, but let's say mostly it's a pro. Let's think positive, right? So on the con side for small, this is something that really plays on single family homes, but it still shows up here, and that's the effects of vacancy. Okay. Okay, so if you've got a 20 unit building and you have a 5% vacancy rate, like, oh, okay, it's industry average, 5%. What's 5% of 20? 1. That means that one of your units can go vacant. Well, what if 2 of them do? Well, what if 3 of them do? Okay, then you're at 15% vacancy if you lose 3 tenants. And believe me, from a guy that owns a 20 unit apartment building, you can have 3 units go vacant at the same time. It's possible. And it's very bad for your cash flow if it does that. Whereas I also have larger assets on this side, and it's something that's in your budget to have larger. The vacancy just doesn't play as much over here as it does over here. Vacancy is like just part of the equation. Like the buildings that I have in this range, they're rarely fully occupied, but they also cash flow. They also do well. You expect to have 1 to 2 units sit vacant on a building like this. Whereas in a building like this, you have a couple of vacancies, you can be cash negative or way lower on cash flow, right? Depends on how you buy them. Of course, buy right and everything like that, but you have to factor higher vacancy rates on a smaller property. And don't get me started on smaller assets like single family homes. Projecting a 5% vacancy rate on a single family home that's pretty much like roulette, right? You might get it right, and you'll probably be at 0% vacancy because the tenants tend to live longer in single family homes, but once they move out, it's gonna be a lot more than 5%, I bet you. So the effects of vacancy on the con side for small. And the other thing that's interesting here, they're hard to evaluate, and that plays in a couple of different ways, okay? Now, if you get lucky, here's one way that they're hard to evaluate, and that's on unit layout, okay? Meaning if you find a 20-unit building that's built as 20 units and it's cookie cutter, meaning all the units are the same and it's like a garden low-rise, as they call it, it's very easy to, okay, if you see, it's one of those buildings, if you see one unit, you see them all. That conversation typically plays over here, where if you've seen one, it'd be like a model unit and they all look the same and everything like that, where you can look at one apartment and say, okay, I'm going to spend $3,000 to turn over these apartments, and pretty much, for all intents and purposes, they all look the same, and so the cost of turnover is predictable. These units might not be that way. They may not be built as that. They might be a conversion, meaning they might have been a larger building that was converted to be a 20-unit apartment building. So the layouts might not be identical. These buildings are also hard to compare to other assets because the quantity of 20-unit apartment buildings in your town or 15-unit apartment buildings in your town is going to be low. And the factors that people use, although they get thrown around all over the time in all these multifamilies, things like cap rate and net operating income that are really used to evaluate. These guys get used to evaluate these kind of properties, but they don't play. And you know why they don't play? It's because of stuff like this. The effects of vacancy and just other things that you don't really get a real economy of scale, a big economy of scale for properties of this size. So it makes them harder to evaluate. People try and squeeze them into cap rates and using net operating income to evaluate and stuff like that. But I find that for these, they can be a little cyclical, a little bit up and down. So the range of predictability of these buildings is tougher to have. Okay, so the far and away the biggest con for these types of buildings is competition. Now, I could get into a whole reason why this is, but just understand that mid-size multifamily has been a good investment for a very long time, having to do with conditions that arose all the way since the crash of 2007-8, right? A lot of people went back to renting, so that drove up prices over here. Those prices have not come down, interest rates have stayed down, and they've become, and still are, a good investment for a lot of capital, a lot of places for people to go with a lot of money that have a large amount of equity to invest. This is considered to be a safe place to be. So people that weren't normally in mid-size multi are now in mid-size multi that used to be in other places like stocks and everything like that. So there is competition here that didn't used to be here in this space because of some of our friendly run to the back of the room gurus and stuff like that. There's become a lot of newer investors that folks like you and me that are in this space because people have read books on it and everything like that, or taken a few seminars on mid-size multi that want to get in. So for all those reasons, and for just the general economy right now and interest rates and all that, there's a lot of competition in mid-size multi. It's common to get outbid, to have these properties go to best and final and stuff like that. So that's a downside, a big downside, because if there's a lot of competition, then you're going to have to pay more, which means you may not make as much money as you would if you paid a little less, or maybe had like 5 of these versus 1 of these might be a better deal, just a tip. But there's a lot of competition on this side, where there's very little competition on this side. So the other thing that plays in mid-size multi, which if you get the right mentor, if you get the right coach, if you get the right people that you watch, if you read the right amount of books, and you get all over BiggerPockets, this doesn't play, but it can, and these deals are complex. There's things like capital expenditures you have to set aside money for. If you don't save money on buildings like this, you will get eaten alive, because eventually your $50,000 roof is going to start leaking, and if you don't save up money to take care of that in the future, you're going to be underwater, literally. You've got to follow the market for rents to make sure that you're competitive on your rents moving forward. You've got to constantly analyze these assets, and they can be way more complex than assets like this are. They're rewarding, they can be, but there's a lot more factors that play in the profitability and the long-term success in management of buildings like this versus building like this. I don't mean property management, I mean asset management, like running the numbers, spreadsheets, projections, rainy day money, that whole thing for assets like this, okay? So these are my thoughts. There's way more conversation that we can have on this. But for as long as this video is gone, I'll spare you going into further conversation. I'd love to have it in the comment section for you guys to leave some comments down below and to get in some chatter about these assets versus these assets. Please, please, please debate me on some of these. Let's get into some healthy conversation. I'd love to hear from you. As always, it is my honor and pleasure to have you guys watch these videos. So thank you for watching all the way to the end if you're watching this right now. As always, I appreciate you and have a great and profitable week.